Hello and welcome to the Higher Expectation Podcast with the Higher Advantage Real Estate. You'll hear from Ron, me, Michael, and Josh, a multi-generational family of real estate experts in Southern California. We'll help you grow your wealth, enjoy life, and spread a little bit of positivity, motivation, and inspiration along the way. Today, my very special guest is Anthony Bruneau from Bruneau Associates, a CPA firm, right?
That's right.
How many offices do you have, Anthony?
We have two. We have one in Palmdale and one in Valencia.
That's cool. That's cool. And about how many people work in there?
Right now we have about 6.
That's good.
Yeah.
That's
Mostly
good.
in Palmdale, but we do have people in Valencia as needed.
Very good. Very good. So, were you always wanting to get into the accounting field? How did that start?
Really, it started. Some people they pick a profession, at a young age, right? Me, I was kind of one of those business majors, right? The people who don't know what they want to do. And I had an interest. I had an interest in like financial planning, right? But then my senior year of college, they started being aggressively recruited by CPA firms, and they made an impression on it. I decided to go that direction instead of financial planning.
Yeah.
And then I worked locally at a CPA firm, and just like any other profession, you learn from the prior generation, right? So you learn their tips and tricks, and then you come up with some of your own, and then eventually started my own firm.
Very good. And that's when I met you, when you were at the other firm, and then you moved and went with you. How long have you been in the accounting business?
At this point, it's been 20 years.
Wow. I
Long
know. 'Cause
time.
I'm really saying that because he looked really young, all right? But he's really, really good at what he does. So when somebody is, you're helping somebody with their taxes, what are some common mistakes that you see that other people could learn from?
So when people make mistakes, it's really in a couple of areas. So like, for example, if you're a business, right, one of the biggest mistakes people make with businesses, right, is they don't spend enough time on their accounting, right? Or they spend time on their accounting, but a lot of people like to do it in-house, right? And they don't bring their CPA in or give their CPA the numbers in time for them to look at them and make sure they're right. Because when you look at business returns, it really starts with the accounting, and the accounting feeds into your taxes. So if the accounting is wrong, your taxes are going to be wrong, right?
Yeah.
When you look at personal returns, right, it's always an issue of did we get everything right? So one of the big things we do, where I tell my staff, is I go, well, if the client wanted to do their taxes, they would have, right? So they're coming to us, and they want us to watch their backs, right? So the big mistakes a lot of times you see is people forget things. Not a lot of times, but sometimes you'll see clients, they'll give you a 2023 document instead of a 2024 document, right? And if you're not paying attention, then suddenly, their taxes are wrong because, their 2023 W-2s in there, right? So we check for that.
Yeah.
People, they forget about deductions, charitable giving, they forget about, deducting property taxes, things of those nature.
Before the end of the year, we always get an itemized list of things to fill out. And I think that's really imperative to help us put our ducks in a row for you to do the proper accounting, right? And you do that to everybody?
Yeah, so everyone that comes to our office, they get an organizer, which is what we call that. And they get mailed, and then we also, for other clients, we also give them digitally. And that lays out basically everything that was on their return last year, has spots for new items for the current year if they need to add things, and it also has a list of questions to make sure that if there's something significant that happened, that we pick it up, right? Did you contribute to an IRA? Did you take money out of an HSA, which is a health savings account? Did you get married, right? There's a big question. Did you have children, right? So we try to make sure we pick up all those things when we do your taxes.
That's good.
And doing that helps us a lot.
That's good. So I know there's a lot of people out there that are maybe shy away from a CPA, and they do their own taxes up to a point. When should somebody really consider about using the services of a CPA?
Yeah, so I thought about that question, and there's 3 answers, right? So one is you start a business, right? So then things get more complicated, and there's more planning involved.
Yeah.
2 would be complexity, right? So there are a lot of clients come in, and they're like, I did it myself, but now I have this new thing, right? Whether it's a K-1 from an investment, or they got a rental property, and they're basically at the point where they don't want to figure it out, or it's gotten to the point where they can't figure it out, right? And that's the time to seek outside help. And the last thing I usually think about is, even in my own life, is when do you hit a point where the amount of time you're spending on it is better just to send it to a professional, because your time is worth money too, right?
For sure.
And if you were to spend time working, would you make more money than if you just hired somebody to do it for you, right?
Yeah.
And then, CPAs are a lot more efficient, so, this can go a lot faster, right, than doing it yourself because
Right,
of specialized software. And,
I was going to say the software, because it changes every year, right?
right. And every year it gets updated, and we go to classes to make sure that we're up to date on the current law. Right now they just passed the One Big Beautiful Bill Act, right? So we're up on that, and I was just studying that last night. Right, so I have time to do that, right, and that takes it off your plate because now you don't have to go figure it out.
Even if I've read it, I don't understand it.
Right. It's very nuanced too. Well, like for example, like a lot of seniors are really excited right now because they're like tax-free Social Security, and you go, well, no, that's not what happened, right? They gave you an extra $6,000 exemption,
Yeah.
but only if you're single, if you make less than $75,000, or if you're married, if you make less than $150,000, right? So you go, so it's very limited, right? It's a small amount. It's you have to have, I'm gonna say low income, but not high income, right? So you only meet certain people, and even those people, they might still pay tax, just less tax.
Right. Getting back to the previous question, when somebody has a rental property, what's the best way to take advantage of the rental income side of tax planning?
So I thought about that one as well, and there's several different directions you can go. So one of the big things right now, and I just got asked this last night by an investor, is they just extended the bonus depreciation rules. So
what does that mean?
So basically, if you go buy, and, I think this leads into one of your other questions, but if you go buy a property and you want to use it as a rental, you can do a cost segregation study on it. So the idea is, you pay, let's say, $500,000 for a house, but the carpet's only going to last for the next 3 years, right? And then the air conditioner might last.
So that's what they're
15.
talking about, cost segregation. You just don't depreciate the whole thing. There's certain parts like...
Because, like, for example, the house, you depreciate over 27 and a half years, right? But then the carpet, you can say that's, 5-year property, right? And 5-year property, you can take bonus depreciation on, which means you can take it all in the current year. So that means that you actually get to deduct that portion of the house right now. Of which, if you have, a year where you have high income, or you have another rental that's very profitable, that is, creates a tax liability, then you can use those deductions now to offset that tax bill. So that's a really powerful thing. Other things I thought about, you deal with rentals are, depreciation is always a big topic.
Yeah.
You always have, for example, I talked to another client, and one of the more interesting things they asked about was, what about a home office, right? Which is not something most people think about with a rental property, right? Usually it's, I have a Schedule C, or, and I can claim a home office, right? Well, technically you can claim a home office in a Schedule E too. The only thing is when we look at the case law, the case law suggests that, the rentals have to rise to a level in terms of activity to the level of a business. And when does that happen, right? And that's the big question. Once it reaches that level, then you could claim a home office. And usually that, if you look at the case law, it's about 3 or 4 rental properties. So you have things like that. If you're a realtor, you can treat it as an active trader business, which the difference between an active trader business and a passive business is that on a rental property, if you have losses, right, and your income's higher than $150,000, then those losses get suspended, which means that you don't lose them. You just can't take them against current income on your tax return. Now, if you're a realtor, those rules don't apply because for you, it's an active trader business. So you could have those losses and still claim them on your tax return. So there's a variety of directions you can go in terms of claiming, deductions for rental properties. Right.
There was one thing I don't think I learned it from you or just real estate in general. Most people think that the value of their home is now 2 things. It's the land is included in the value of the home, and then you have the building, but you can't depreciate the land.
That's right. So you have to segregate the land from the building, and traditionally the way that's done is you look at assessed values with the property assessor. So whatever the assessor says the land is worth, we would either take that or we would prorate it against the building.
Yeah,
that's a lot of times how we determine it. You could do an appraisal, but that's the most common way.
Yep. As far as if somebody wanted to use tax planning as a way to create generational wealth, what is the best way for someone to do that? Now, it probably takes a long time, but how would somebody go about doing that? Really, with intergenerational wealth, right now, so one of the big issues with intergenerational wealth is estate taxes, right? And right now, they raise the threshold on estate taxes to estates larger than $15 million if you're single, or greater than $30 million if you're married, right? Wow. So if you have an estate that's larger than that, then that's where tax planning really comes into play, right? Okay. And then when you look at that, you're looking at things like, how do you transfer wealth that avoids, infringing on estate tax rules, right? So, annual exemptions for 2015 are $18,000, right? So you can get $18,000 for the,
per spouse, right, to your kids, to your grandkids, right? So you could give, you have 3 children, you could give each of them, if you're married, $36,000, right? So that's almost $100,000
Per year?
per year, right?
Oh.
And you can do that, indefinitely, right? And, exceptions, in addition to that, right? There's rules that say that, hey, if your kids have medical expenses or your grandkids have medical expenses or they're going to college, right? If you contribute money directly to the college, right? So you pay their tuition directly, or if you pay their medical bills directly, right? That's not subject to those gift tax limits.
Wow.
So a common strategy with more affluent taxpayers is they give their kids credit cards, right? And they're saying, well, every time you go to the doctor, right, use my credit card because now I'm paying your bill directly, right? And then we're avoiding those gift tax limits.
I was going to say, how would more affluent people take advantage of these tax benefits? And that the credit card for the children, and they could use it for medical and college.
Right. And avoids those limits. For more affluent taxpayers, you also have what they call it NIMCRUTs. So that's a net
What's
investment.
it called?
It's called a NIMCRUT. So it's a net investment trailer remainder unit trust.
Uh-huh.
And what that is basically, so for example, like a powerful strategy of real estate, right? Is let's say you buy, let's say go back to our $500,000, right? So you buy this rental property for $500,000, and it depreciates to say $1.5 million, right? Well, if you gift that to a charity, right, you get the deduction at $1.5 million, even though you've only paid $500,000 for it, right? So that's by itself is a pretty powerful tool,
right?
But not everybody wants to just give their property to charity, right? So no matter how much deductions they get for it, So then you have this issue of, well, how do I get something out of it but still give to charity, right? So what you do with these trusts is you give the property to the trust, right, and then you create what they call principal beneficiaries and income beneficiaries, right? So the idea is with an NIMCRUT, you sell the property, right? And then when you pass away or when the trust ends, right, the principal or whatever you sold the property for, right, that goes to the charity, right? Okay. But then during your life and up to 20 years after you pass away, right, that invested money or the rental income, right, goes to the income beneficiary, which would be you and your children if you pass away or your spouse, right? Wow. So then you're going, okay, every year I get to take out money as an income stream, right, and turn around and pay my bills with it or invest it. I get to give to charity in the future, right, when I don't need the money anymore, right, and then the present value of that future gift, right, I can deduct on my tax return today. So then I get this large charitable deduction potentially, right, and I've avoided picking up the income from the sale of the property, right. So there's a really a tool that can meet multiple goals, especially for older taxpayers who are sitting there going, well, I don't need the money. I don't necessarily want to give it to my kids right now because maybe they don't need it or I feel like they should work for it, build up that work ethic, right? Right? But I want to keep the money, I want to make sure I have income, right? Because it may be, end of life care, right? Nursing homes is very expensive, right? So I need to make sure I keep money back for that, right? So how do I meet all these different goals that I have? And that's something that's very tailored to high net worth taxpayer.
Very good. I hope you're enjoying the podcast. If you're thinking about buying or selling real estate, or if you know of somebody thinking about buying or selling real estate, we would love to help them. Feel free to give us a call, text, or message us here. And now, back to the show. So getting into part of that answer, there was when rental income appreciates, and over time, you can only depreciate it for 27 and a half years?
For residential, and the commercial is over 39.
Okay. It brings me to the thought of the 1031 tax code, the IRS 1031 exchange code. Can you explain that one a little bit and how that would work with the tax planning?
So on a very basic level, a 1031 exchange is basically instead of selling the property and taking the proceeds, right, you sell the property, the proceeds go into basically like an escrow account, or they call it an accommodator is the technical term, right? And then you go pick a new property, and then the proceeds are then used to purchase a new property, right? And if you meet all the requirements, the whole thing has to be wrapped up in 180 days, for example. Okay. And then the sale of the property is tax-free, and then you can reinvest the proceeds in a new property.
Right. So if you sold the property without doing the 1031 exchange, you'd have to pay capital gains if there was appreciation in there. But on 1031 exchange, you don't.
You don't. And until you eventually sell the property down the road, right? So if you take that replacement property and then sell that and take the proceeds, then that's when the tax bill would be triggered, or the gains would be triggered on the sale.
Wow. That's good. So a lot of these 1031 exchanges I've seen, the owners have created either an S-Corp or an LLC. How does that benefit the taxpayer, whether it's an LLC or an S-Corp? Are there any difference in those two?
Well, for real estate, typically the standard vehicle, I mean, some people do S-Corps. I've seen it, right? But ideally, a rental property would be an LLC.
Okay.
And the reason for that is with an S-Corp, you have to think about, again, intergenerational wealth and wealth transfer, right? So in an S-Corp, you have to say, well, an S-Corp has basically they call it a legal person, right? So an S-Corp independently of you exists legally, right, as a person, right? Whereas an LLC, if it's treated as a partnership, right, it's basically indistinguishable from you and your partners, right? So from that concept, you go, well, if you pass away, right, when you pass away, you get a step up in basis. The idea is the IRS values all your assets at the day of your death, and then your heirs, when they inherit it, that's what they consider to be their cost basis. So any gains are figured out from that point forward, not going back to the original purchase. So when you look at an S-Corp, you go, well, you own the stock, you don't own the building that is inside the S corporation. So then you get a step up in basis in the stock, but the building inside the corporation doesn't, right? So then you have this issue of, you can't redepreciate the building, right? Now you can sell the building and you can collapse the corporation and then it comes out okay, right? But if you want to hold the building, then obviously you want to be able to redepreciate it after you pass away. Because if you get that step up in basis, then you can reevaluate the building and then redepreciate it, which is something going to happen in an LLC, but not in an S corporation. So usually an LLC is a preferred vehicle for real estate investment.
And if somebody had a trust, they would add that LLC to the trust. Is that what they would normally do?
Right. So you can have a trust that owns an LLC, and then when you're alive, usually it's considered to be a disregarded entity because it's a revocable trust, right? So until you pass away, you can change the terms of the trust. Yeah. And then and also that's a common way to when you get into like legal entities in terms of asset protection, right? You don't usually want to be the direct owner of an LLC if you can avoid it, because then people know who owns it, right? And they know who to go sue. But if you have a trust that isn't named after you, right, then they go, well, who's the owner of the trust? Well, who knows? Yeah. Right. So then it makes it harder to determine who owns the property, and then that protects you that way in terms of frivolous lawsuits and things like that.
Very good. Yeah. LLCs and trusts and all things are all designed to help protect the owner. Yeah. Very good. S-Corps too.
Right.
So, getting away from this one a little bit, what is the craziest legal deduction you've heard of or you've helped somebody with?
So there's a couple. So I was thinking about this. They're not necessarily large ones, but like, for example, I had a gentleman and he had put solar in his house, got a tax credit for that, right?
Yeah,
and
then
Solar, right?
Yes.
So that wasn't particularly crazy. But what he did is he had a pool. So he was like, well, I want to get tax credit for heating my pool. Now, so what he did is he went out and bought an air conditioner, right? And this air conditioner was actually a heat pump too. So instead of cooling your house and then exhausting the hot air out, through the condenser, right? It actually pumped the heat into the pool.
Oh.
And it was eligible for a tax credit. I thought that was pretty cool. I was like, I'd never even heard of this thing. And
that's a good one.
Yeah, he must have researched it because he came in and he's like, this is eligible for a credit. And I'm like, really? And then going back to intergenerational wealth question, right? So I had a client, same idea, right? Grandpa gives daughter, or dad gives daughter a credit card. She goes out and pays for medical expenses, right? And then you go, well, now he's transferring wealth, right? Because he's getting above those annual gifting limits without paying tax, right? And then if you look into tax law, tax law is usually integrated with state law, right? The tax law says, well, if you're in a state where, so for example, like in certain states, they look at it like, okay, well, grandpa gave you money and you choose to use the money, or dad, right, to go pay your medical bills, right? So in substance, you're paying your medical bills with his gift, right? So you're still paying him in substance, even though he's directly paying the entity. So if that's the case and you're in a state where they look at it that way, even though you didn't pay those medical bills, you can still deduct them on your tax return. So,
okay. So the person using that benefit to pay the medical bills or college, they don't have to pay tax on that, do they? As like income, right?
Right. So you look at it and go, well, because you think, well, grandpa paid the bills, so you should get the deduction, right? You go, well, he can't because the child isn't his dependent anymore, right? And then the child doesn't have to pick up income, like you're saying, because it's a gift, right? But they still get to deduct the expense even though they didn't pay for it. So you go, well, how can you're winning every direction, right? He's reducing his estate, he's transferring wealth to you, and you get the deduction without paying tax on it.
Yeah. So this is complicated, way over my head. So if you've got an issue like this, call Anthony, all right? Because he'll take care of it.
Well, we'll work it out.
Yeah. That's awesome. So, and have you ever had anybody try and deduct things that are not deductible? And what's the craziest one of those, if you can think of any?
I mean, usually it's, I went on an exotic vacation. How do I deduct it, right?
Yeah.
Child medical, right? Again, a lot of people like, I paid it, so do I get to deduct it? No, you don't, right? Because they're not your dependent anymore, right? So usually it's that. Sporting tickets is another popular one. So usually entertainment driven. So usually it's basically, I'm having a good time. How do I deduct it? And then it's like, well, in most cases you can't, right? You can come up with some ways to do it, but a lot of times it's limited.
Very good. Very good. So as you can tell, I mean, the CPA world, accounting world, very complicated, for way over my head. And that's why we have people like Anthony to take care of those things, because I don't want to do it, number one, and I'm not good at it, number two.
Right.
And I'd rather have someone like you take care of it for me. And if there's anybody else out there like that, Anthony would love to help them as well. So did you have any mentors before or as you were coming up in the accounting world? Anybody that had any influence on you?
Yeah. So, so a CPA is like a lot of professions, right? You have to practice under a CPA. So, and then, over time you learn from them, and eventually, you gain their level of confidence. So my former partners in my last firm were major mentors, right? They taught me, basically all the major disciplines in accounting, right? Whether it's tax or audit or accounting. And then, starting my own firm, I also brought on, more senior CPA who worked for the IRS. And, he's taught me things like, for example, going back to your crazy deductions, right? Being a more conservative CPA, or in the past being more conservative, things like when people want to deduct their boat, I'm like, it's your boat, get out of there, right? This gentleman is an ex-Irish auditor, and you're talking to him, and you're like, well, this client wants to deduct his boat. And he's like, I don't see a problem with that. Right?
That's good to have that on your side.
Right. And you realize, perspective, right? So you look at it and you go, well, when you look at like taxpayers, right, you have to think about, what is normal at different levels of income, right? And then when you deal with bigger and bigger contracts, or bigger and bigger jobs, or bigger and bigger businesses, right, the people they hang out with, their spending habits are radically different than other people's, right? So you have to think, well, what's reasonable for that level? And for that taxpayer, it was reasonable for him to have a boat, because, he needed the boat to be able to go out and, network with people in his, income level, right? And then bring in those contracts to run his business, right? So you go, well, so for him it was reasonable, but for a lot of people it may not be. So it's really situational, right? So, mentors, they bring those, those outside perspectives, right? The outside knowledge base, and then you can build off of that and then become a better professional.
Yeah, I like that word, reasonable, because it's all in the perspective,
right,
and the context of the tax bracket or tax income level and different things like that. Very good. So I know you work a lot. How do you relax? How does Anthony Bruneau relax?
Well, right now it's been a variety of things. So the wife's on vacations, right? So I've been vegging out, watching a lot of TV, Netflix. Recently in town, there's been a new soccer team, right? So I've been going to a lot of those games. Those are pretty good.
Good.
Last weekend I went hiking, right? So
That's
I go out
nice.
and get some of that nature. I got sick of Netflix eventually.
What was that?
I got sick of Netflix, so I decided to go hiking. And then I also collect stamps. I also like to travel, right? So I've been, to Europe and to Asia. I think foreign cultures are very interesting, right? Learning about how other people live, and then just seeing, the contrast between how we live in the States versus how they live, and how similar it is and how different it is.
Yeah, I'm sure that gives you. I don't go very far. I let my kids travel, and then they come tell me about it, Anthony. And then they always say that there's no place like home. It's like coming back to the United States. It's totally different outside. Nice to visit, and then some people might want to stay there, but it's nice to come home to probably familiarity more than anything.
I think so. It's like American food. Like, I can go to a different country, eat their food, and appreciate it, right? But in the long run, it's like there's nothing better than American food. And it's just because I grew up eating it, right? So I'm used to it, right? It's comfortable.
Yeah, very good.
Yeah.
So we have a segment of our show called Quick Pitch and Rapid Fire Questions. And I'm going to start out with, so you did say you want to go hiking. You like going hiking. What do you prefer, beach, ocean, or desert?
Beach, ocean, and desert. Probably the beach.
Because?
I just think it's relaxing. Like you sit there, you watch the waves, you go play on the beach, go jump in the water. You know, it's a lot of fun.
It is fun.
Yeah.
It's very good. What is your favorite meal?
Probably pizza.
Pizza. I love pizza. Yeah.
Not sophisticated, but I like it.
And well, there's lots of different kinds of pizza out there, so that's good. But do you prefer winter or summer?
Winter.
Winter. Yeah, me too. It gets too hot. I can put more clothes on. It's tough to take more clothes off at some point.
That is true.
And what's your favorite holiday?
I would probably pick Thanksgiving.
Thanksgiving is a good one, right?
Yeah.
People get together and just enjoy lots of food and be thankful for everything that we've had, right?
That's right.
That's a really good one. Do you have a favorite quote or saying that you lean on at any particular time or sometimes?
And it's kind of funny because in our office we have our weekly team meetings, right? And every week we read a quote. You know, it's a kind of give us inspire us for the week. And well, I forget most of them, right? One of the ones that always sticks with me, right? They do inspire me at the time. The ones that sticks with me is opportunity is when preparedness meets what is it? Success is when opportunity meets preparedness. Is that's
something like that? Yeah, that is good. Yeah.
You know,
that's a good one. When you're being prepared, and then things pop into your world, then you're ready to act on them.
Right.
That's a very good one. Very good one. And I've said this one before in the past. I was like, I forget what mine is. What is mine? It goes like this.
It's rapid fire.
No, it is. That which does not kill you makes you stronger. So anytime we've had some tough times and you get through them, you learn from those experiences, take them with you, and either know what not to do, and you just learn from them going forward.
And it's true.
Yeah. So if somebody wanted to get a hold of you to help them with their accounting, whether they're a business or personal, how would they get a hold of you, Anthony?
I think the two easiest ways are, you know, our office number. So it's 661-952-5476. You can also visit our website at brco.cpa, and then you can find our email address, our phone number, and reach out to us.
Very good. And we'll drop those links in the bottom of the podcast as well. And for sure, like and subscribe to the podcast. Thank you very much.
Thank you.
I appreciate that. We had a great time, great information. And remember, for higher expectations and higher standards, choose the higher advantage, real estate, sales, and service. Take care, be safe out there, and have a great day.